All right, I gave you some homework in the teachings for this month in regards to the Kiwi dollar. So I mapped out an area, and let's take a look at that on the presentation slide. Okay, you should be able to see the presentation slide. Okay, and I asked you to go in to look at all these swing points in here and study them in reference to PDAs and also what would qualify those as swing trades. And I left that up to you to determine what was the framework that led up to those particular lows and subsequent price moves higher. Okay, so we're looking at the monthly chart of the New Zealand dollar versus the US dollar. And I want to take your attention to the low that was formed here and the high that was formed here. Between the two, we had a range of about 1,260 pips. So 1,260 pips of a total range for the New Zealand dollar versus the dollar index. If you're not getting audio, you probably can't hear me say this, but nonetheless, it's just you. Just confirm one more time. I got to create an edit marker. Audio is still good for everyone? I just got one guy telling me. Okay, thank you. So my question is what led the low here to this high in terms of the range? And since we're looking at a monthly chart, what was the PDAs that were useful in determining that type of movement? And also keeping in mind what those swing points were on the chart I showed you in the homework. So now we have that range defined. We have this up candle here in the monthly. This is a bearish order block. It was a bearish order block because it was completely moved away from aggressively, and it was the last up candle, and all these down candles created a range that needed to be filled in. So all this stuff is applicable to the monthly chart as well. So we have a low down here, which we're going to assume that we didn't even see this low form. Once we saw this candle trade through it, in other words, this down candle, once we traded through it, that qualifies this as a bullish order block. That's how we're going to go forward. We don't need to know why this low was formed. There's plenty of reasons why we can justify that. But for now, I want you to focus on just this low and the range high up here. This high up here is completely linked to this last up candle or bullish order block. I'm sorry, bullish candle prior to the down move, which is a bearish order block. This move here, this subsequent slide in the Kiwi, was a move away from this consolidation. We return back to it here. So while price was delivered on the monthly chart, once leaving this up candle, breaking it here, price was delivered on the downside here, 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 and here. So price had to rebalance on the monthly to get back up to this area here, this low on this candle, and it's open. So there's your PDA or reference point on the high end, and the low end, we're going to assume that this is just old low. So we have to start looking for where price would look to form support levels. What levels would offer institutional sponsorship for buying? What PDAs would be used in that idea? Well, that would be mitigation blocks below us. It would be bullish breakers. It would be liquidity voids that need to be filled in after a rally up. It would be a fair value gap below market price. It would be a bullish order block. It would be a rejection block below the candle's bodies and below an old low or at an old high. There's your PDAs that you would be looking for. Well, if you start applying those to the monthly chart, you end up with something like this. And it looks rather busy, I know. And this is the reason why I don't show all my charts all the time. So when we go through price action study and I refer to specific levels and I say, and it seems a lot of times like it's off the cuff, like I like this certain level or I like that certain level. What you're not seeing is I'm actually breaking down the monthly and the weekly and the daily like you're going to see in this teaching here. So I have these levels in my notes and also have these levels in my charts apart from the things I show in either the live sessions or if I show you something on like on YouTube when I was doing free tutorials and sections on price action, I would keep my charts real clean, which I think in a way promoted the idea of confusion while I stayed in the realm of free teaching, because it was hard for people to grasp where I was getting these levels from. Why was it so, why is it that level? You know, and sometimes it would line up with an obvious bearish order block or a bullish order block, or it would be an obvious higher low, but not always. And the reason why is because, like I said, I didn't want to give the information out. Okay, so you're paying for it, so you get to learn it now. So what we do is we go through the monthly chart and we identify a low and we identify a high of some sort. In other words, we define a premium level we clearly can see, and we outline or define a discount level, or basically in common terms, a support resistance. Now, the reason why I didn't say support or resistance because it's too vague. Nothing you're learning in this teaching or in this mentorship is vague. Supply and demand is vague. It gives you ranges. I'm going to give you specific levels, exactly what the algorithm will reach for and why it reaches for these levels. We don't look at zones. We don't look at areas. We look at specific price levels. Price levels have to get to this level. If it fails to get to that level and hovers below it, we wait for it to trade up to it. If it trades to it and rejects, we start looking below that market price, okay, for the discount or the PDA's below price action. There's nothing ambiguous about what you're learning. You're going to be learning specific price levels. As we outline this, just remind yourself constantly, this is not supply and demand. This is exactly to a level. It's not an area. It's not a, well, if it gets up in this area, I'll look to sell. Where do you look to sell? And supply and demand and resistance and support, which support and resistance level do you use? There's all kinds of ways of defining support and resistance. Diagonal support and resistance, horizontal support and resistance. Which one are you going to look at? An old low, an old high? Which candle, if you're looking at specific candle patterns, okay, for support and resistance, which one are you doing? See, that was the struggling point for me. And when I understood what price is actually reaching for, it enabled me to define it to specific price levels. So just remind that that's the main takeaway of this teaching today. So write in your notes right now, main focus point today is how to determine specific price levels, not zones. And we're going to break that down now. All right, so we have this down candle here that was validated as a bullish order block. Okay, now I understand this is going to be a little bit busy, but you'll have to endure it because there's no other way for me to do this without actually making 1,000 different slides, okay, and then really beating it to death. But you'll see it's not that hard to follow. I'm going to get rid of the green background because we know what we're looking at now, the range. And we're going to start here. Each dotted vertical line or dashed vertical line, let's say it like that, Michael, okay, references a down candle. Okay, so we saw price come down here. We're going to assume we anticipated some measure of support. Even if we didn't, who cares? Because the bottom line is this candle here now validates this as a bullish order block. So we have to now start thinking, okay, this down candle, it may be sensitive in the future for support. So we have to refer to this PDA in the case that it should provide support. If it breaks down, then we know that the trend is going to continue going lower. In this case, we saw price trade through it on this up candle, so now we have to refer to this down candle as a potential bullish PDA. So if we know that this is a potential bullish order block and price could move higher, the immediate point of decision for you is, okay, if it is going to go higher, and if this is in fact a bullish reference point or support level, where is the resistance, or in a way we determine it, where's the premium level that the algorithm should reach for. You start looking, okay, going through your whole list of things. Above market price would be mitigation blocks, bearish breakers, liquidity voids, fair value gaps, bearish order blocks, rejection blocks, old highs or old low. We have a void in price in here. We have a fair value gap in here. Price is only delivered in this small little section here. We have a bearish order block here. We have the low and the opening, both defined, okay? And then we have what would be a rejection block above the bodies of these candles in here. And then we have the old high, okay? And then we have an old low back here. We're not going to define every single one because it would be a lot more information on here than it needs to be. But I'm going to show you how I take this information and I keep it user-friendly to me, because even with all this on here, I'm sure a few of you are saying, wow, that's a lot of levels. Which one do I use? You're going to see it's very easy. Trust me. Just go through the process with me. So we define this down candle with a vertical line delineating that. Now, why am I having a vertical line dash like that? Because when we drop down to a lower time frame, you need to know where that marker or that PDA on the higher time frame begins. It will be very easy for you to be confused if you don't do this. In other words, if I have this level, for instance, this line here, I have it defined as a bullish order block on the open. Okay, well, what that means is this is the bullish order block. It's the down candle right before the up move, but it's the open of that candle. So I define the levels with a label monthly bullish order block, and I'm referencing as the opening price. This one here, a little bit thicker, says monthly bullish order block mean threshold. What that is this candle here. Okay, I'm referencing this one. And how I know that becomes a level of future interest, I have to delineate that with a vertical dashed line. So that way everything to the right of that dashed line references this mean threshold, so the price should be sensitive to that. The opening price on this candle also is this line here, the monthly bullish order blocks open. So it's this one here. So this candle, its open is here, and this candle here's high. You can't see it because the vertical line. Let me just scrunch it over here a little bit so you can see it. There's that high right there. Okay, that's why I have it like that. Now I have it back where it needs to be. So everything to the right, when we drop down to a weekly and daily, everything to the right of this dashed line represents this bullish order block. Everything to the right of this dashed line represents sensitivity for this bullish order block, and it's in respective levels. And then you have this down candle, which is delineated by a dashed vertical line. Everything to the right of it, those levels, this is the mean threshold of this bullish order block. This is the opening price of that order block, and this is the high on that order block. Now, folks that don't understand order block theory, okay, they quickly walk away from it when they start having to deal with, okay, is it the open, is it the high, is it the low, or is it the close? I'm commonly referred to as, I quote precision, but it could be either one of those. Well, it's not either one of those. It's with a bearish order block, you're looking at the low, or you're looking at the opening. On a bullish order block, you're looking at the high or the opening. That's it. They're two reference points. They're the most two sensitive price points. If there is a gap, okay, if there's a gap, that's going to impact your ability to determine whether or not you're going to be using the low or the opening. It's simple. So, or the high or the opening for bullish order blocks. If it goes below those two reference points, and it can, and that's the part you never know for certain, that's the reason why we trade with stops, then you have to concern yourself with the mean threshold, because that becomes the last line in the sand. Now, that in itself also can be violated on a short-term basis, so you have to allow some measure of adversity in your trade. You can't define your trade, okay, until it moves away from an order block like that and it starts moving away. Then you can start being more specific or defined about where your stop loss are. In other words, what I mean by that is, say this down candle here, when it becomes valid as a bullish order block, right in here, okay, this down candle becomes a buying opportunity for smart money. It's validated when we see price move away from it. That shows that they did buy it. Then you can start looking at the mean threshold here, okay, as a means of supporting the idea that your stop should be at that level or just below it. Because price has already moved away from it, it's shown a willingness to move away from it, so now it should not return back to this. The initial trade back into it the first time, it can go down to the mean threshold and violate it just a little bit and still be a valid signal. As you can see over here, it does it at a later time. But this is a monthly range. There's a lot of pips in here offered before it even trades back down here. Each little square delineates the area at which I told you to study for the swing trade. We'll see those when we drop down into the weekly and daily. So I mapped out every single order block in here, and also just for this one, I have just the opening on this candle right here. I have the order block high, which is this one, and this level here is the open on this order block. I'm going to see the significance of that. Up here we have the premium level we identified. We're looking at the bearish order block, which completes this range of down delivery of price or sell side delivery only. Price should rebalance by moving higher up. I'm referencing the low of the order block. I'm referencing the open on the order block and the mean threshold of that last up candle. Okay, so there's your premium levels, and it's not a zone. They're specific price levels, and we're going to talk about what we do with these levels to refine them when we go down to a lower time frame. So this is what I've mapped out. Now, what you do on your own charts is up to you to keep these levels, I guess, easy for you to follow along. To me, I just know what I'm looking for. I'm used to doing it this way. I certainly don't want to press you into a mold where you have to do it this way because you're being introduced to it. It's going to offer a lot of different levels, and when the levels are traded to, what I like to do is I like to dim the color to like an off gray, kind of like when you see me doing the thing with the buy side liquidity and sell side liquidity on our charts on a daily basis. When it trades to a level, as we'll see today in some of the charts, actually went down below sell side liquidity areas or liquidity pools. Once that's hit, or in other words, once they've traded at the order block and moved away, I will keep the level there, but I'll just change it to a gray level. So that means it's reminding me that they could reclaim that level later on, but it's already acted as a driver for price to move away from that particular level. In other words, if we've seen price come down to this level here, the monthly bullish order block open, if it trades at that level and price goes higher, I will dim this color from a blue, which would be like an active color for me for buying. I trade it for a dim off color where it shows me it's already acted as a support level or it's already been capitalized for buys. So it's not as sensitive or high impact anymore. I'm going to be looking for the ones that haven't been traded to. But this is how it starts. You frame out the marketplace like this with these ideas. Now, obviously, you wouldn't have this level here, okay, all these levels when price was trading here. You would only have the levels that's directly related to this candle and then the premium level up here identified. But when we drop down into a weekly chart, okay, and I'm going to take these orange boxes off, all that was showing the separation of every 3 months or so. So you can see how that, before I take them off, you can see how they pretty much peg every major intermediate term swing on a weekly basis. It's every 3 months or so. Okay, so we're looking at the weekly chart. And here's how that vertical line delineates the bullish order blocks. Here's 1, here's 2, 3, and the most recent one here. So everything to the right is going to be sensitive to that bullish order block levels, the high and the open and the mean threshold. I want you to take a look at how price also creates on the weekly chart its own lower time frame PDA levels. So for instance, we have the down candle here, the high, the open, and the mean threshold. What do you think that low is reaching into, and what do you think that low is reaching into? We're inside of the big bullish monthly order block because here's those levels here, and I did not put the mean threshold on that lowest low because I want to show you what we're seeing in the weekly chart, because you wouldn't necessarily have that much emphasis placed on the mean threshold because you don't know for certain if it's going to be a bullish order block until we get this move here. Once it rallies through, then it becomes its validation for a bullish order block. Price comes down into the mean threshold of this down candle here on a weekly chart. So everything that we've done on a monthly, you're going to do the same thing on a weekly. Now, again, what I do is I have a separate chart where I have the levels on a monthly, and I do them in line segments, okay? And you actually see me do this when we start applying it all. But for now, I want you to show you how it is developed, and you look at it and find it on your own charts. From the monthly basis, you draw the levels from a discount, outline your PDAs, your bullish order blocks and such, and your premium levels, where your bearish order blocks and such would be above market price. Once you identify that, you're identifying specific price levels. You're not doing zones or any kind of shading area, like doing boxes or anything like that, but you're focusing on what price may reach for in terms of specific price levels based on these higher time frame levels. Right away, you can see how much sensitivity just by dropping from a monthly down into a weekly has caused for these levels. The only thing that these two levels down here don't show is because we didn't have any reference point with the weekly on the chart yet. And that's what we're seeing here. Okay, so you can apply that here without creating mass confusion, having a multiple array of things for the weekly chart applied. But I want you to see just the monthly alone is enough. And so if you focus on the monthly PDAs, that will give you really stellar setups for swing trading. It'll also give you really good setups for your short-term trades as well. So we have the market create a short-term low, price comes down, takes out that low, and returns back into mean threshold of the last down candle on the weekly basis. With that one aside, let's just start moving forward in the delivery of price. Price opens here, trades back down into, what's this level here? If I can get it to show up. It's a monthly bullish order blocks open. So it's coming back down into the opening of that order block. This one that was started over here. So it's coming back, capitalizing that level again. The level is, the low comes in at 65.75, and we have 66.02 delineated as our order block open, again on a monthly range. Price shows a willingness to want to move away, comes back down. Two bodies of the candle equal in here. We have a monthly bullish order block high. It's trading into that level there. Okay, price shows a willingness to be bullish as well, rallies back up, goes into the monthly bullish order block mean threshold. That would not be that one, it would be this one here. Yeah, so that's, you have to be, this is what I'm trying to tell you, you have to be mindful of it going forward because you're looking at this one here. So when you trade through or from these levels, you dim them out, go to a gray level, or like I do, I go and I use trend lines segments. In other words, I draw from a specific level where it's only one little piece of a line out to the right. And that keeps my charts very clean and orderly. But for some of you, that may not be what you want to do. You might be comfortable using the horizontal lines like we're doing here, but just remind yourself that it's going to cause some confusion as we go forward. And if you don't find a way to dim these levels out as you go forward, you will refer to them, at a time when you probably shouldn't be looking at them. But nonetheless, just looking at the price alone, how many times did price respond off of these levels, and what was the significant outcome? They were not small little moves. They were big moves. They were small ranges before the big moves, but the price swings were driving towards a monthly PDA or bearish order block at a time when the market was already showing a willingness, as we shown yesterday with market profiling. This market was moving higher. It was showing evidences of every down candle was seen with new buying. We have a down candle here. Price showed willingness to buy at it here because it traded back down into it. This movement here came by way of bouncing out more buying here, there. And was there buying? Yes. This down candle here, when price traded down into it, did it repel price higher? Yes. This is how you see professional accumulation. It's supporting the idea that there really is smart money buyers in the marketplace. You don't need trend lines. You don't need moving averages. What you're looking at is institutional order flow. At its core, essential tenets, this is what it looks like. If you're bullish on a market, the evidence quickly that you know that you are seeing a bullish market and that is real buying going on, you don't need footprints. You don't need ladders. You don't need all these other things out there. You just simply look at what price is showing you. If price is supported with down candles being traded to and prices moving higher off of that, there's smart money buying. It's as easy as that. So every time we see a down candle, are we seeing buying? Yes. Here's a down candle here. Price comes down into it. It's in that range. Is it buying? Absolutely there is. Okay. We have this 1, 2, indecisive candle 3. This whole series is a bullish order block. Price trades back down into that. Is it buying? Absolutely. Here's a down candle. Price trades down into it. Is there buying? Absolutely. Does it get through the previous area of premium? No. But it trades up into that area of premium. And the lowest one above the marketplace was the bearish order block's low. And that comes in at 73.87. Now, the way I use this information is if that's the high I'm looking for, 73.87, which is the bearish monthly order blocks candles low. We round down when we're below the marketplace. We're below the marketplace, so price trades up to these levels. We do not demand that level or higher. We look for an exit that's early. So if we're looking at that level, 73.87, we could use 73.85. 73.80 would be, in my opinion, the best one because it's the institutional round 80 level, and the markets like to trade to those levels. But the high goes all the way through the monthly bearish order blocks open at 74.46. So you could use 74.45, round 5 number, or the 74.40 level. Or if you just want to be safe about it, you can just do the 74.20 level, institutional level, and just allow that extra 26 points for someone else to try to catch. And here's what happens if you try to reach for the mean threshold. It's 75.23. The high comes in at 74.85. It gets almost there, but it can't do it. So we have buying here off of this one. Okay, price comes back down. There's a little bit of buying in here also. Rallies. In here, price is reaching into monthly bullish order block mean threshold. So the mean threshold, down candle, that's what we're seeing the buying opportunity off of here. So when you look at price, every time there's a rally, look what you see here. Monthly bullish order blocks open. Same thing here. 1, 2, the level it's trading off of here, monthly order block high, and bullish order blocks open. So every one of these specific price points for swing trading, now we're not talking about day trades or anything less than a 4-hour basis. The way you frame it is you're looking for institutional order flow to support the idea that price wants to go higher or lower. In this case, we're seeing evidences that it wants to go higher. Why? Because every down candle finds some support and they capitalize new longs off of those down candles. And it's also occurring at our monthly PDAs. The monthly chart is this is all those levels. There's 1, 2, 3, 4 bullish order blocks on a monthly chart delineated by the vertical dashed lines. And all of the blue lines are just referencing the high of the bullish order block, the open, or the mean threshold. The mean threshold are the darker, thicker ones. Okay. When we drop down into a daily chart, things get a lot more clear. Okay, so here's our first bullish order block. Price trades down into that level in here. Price rallies away. And you can quickly see how moving into a daily chart, you can refine the order block to reduce the risk that we've already arrived at on a monthly basis and or a weekly basis. Price comes back down. Here's that first return to a mean threshold of the weekly bullish order block, which is what we just outlined a moment ago. But it's also, look what it's done. It's coming down below a daily low, where what would be residing below that low? sell stops. So it's a liquidity pool it runs down into, and then does it show a willingness to get back above that low? Absolutely. As soon as it goes below, it rallies back above it. Now here's where the rubber meets the road. We have now the bullish order block, or PDA, on a daily basis, with the monthly calling price potentially up to here. The down candle is the bullish order block, or bullish PDA, on a daily basis. This down candle, you look at the body of the candle, not the wick to not the high end or the low end, or the actual highest high and the lowest low. You look at the body of the candle. That's the order block. You take that range, okay, and if all you need is at least 2 times that range to give you a valid buy. That's your filter, if you will. If you see that, if price moves away from that much and comes back down into it, you have a very strong probable buying opportunity. Why? Why is that significant? Because it's showing a willingness to displace price high enough to indicate not just a minor little blip. It's wanting to go higher because there was real buying going on. Price comes back down into the order block. Doesn't get to the mean threshold, but it does trade at the open. Open on this candle is 64.42. Opportunity to trade back up into the void in here. All this price delivery is only on the sell side. And we also have this down candle right here, right before this new high, above this high here. That makes this what? A breaker, bearish breaker. So you have your PDA in the daily time frame here, all with this void. So you could be a buyer down here with the first objective of getting up into this breaker here, or you could use this mitigation block. Price hits it here, consolidates, trades right back down to the bullish order block here, and then rallies again, ultimately up into the breaker right there. Then price trades down into, creates another opportunity to be a buyer right in here. Takes out a short-term low. What's below that? Sell stops. What's up in here? Bearish order block, potential breaker block, which is above these bodies of these candles. Price rallies up and trades through that. Now again, the moves are not small. They're significant. While we're aiming for 2 weeks or longer, if you get several hundred pips, you got to bank some of that. You just can't just marry it and say, okay, well, it's going to go for 2 weeks because therefore it's a swing trade. It has to be a 2-week hold time. No, if you get several hundred pips, you need to profit bank that. It's where price meets that. You're just allowing the 2 weeks or longer to pan out. You don't want to force the idea. Because say, for instance, if you get in a trade and it moves 600 pips in your favor in 5 days, are you going to force yourself to hold on to 2 weeks or a month because you think it's going to bleed out more for you? Or are you going to take a considerable amount of profit off the table? Preferably, you should be paying yourself. You should have paid yourself several times in that move. But don't think just because the duration of the time of these setups are there for 2 weeks or longer that you have to hold that long. Don't think that way. You have to consider where prices move to. But making profitable exits along the way, scaling out, is essential. But every time you get a new buying opportunity, you can add that profitable portion you took off back in and then build that position right back in. But you see what you already made. You made money. You allowed yourself to weather a little bit of the retracement if you're going to hold some piece on the position longer. And then you can add that position back on at a later time when there's a new buying opportunity. Down candle right in here. Measure the body. 1, 2 times. It's a valid buy. Price comes back down. Hits it. You want to be a buyer here. Notice that it's really close to the mean threshold of the bullish order block, and it's also inside of the high of the monthly bullish order block. So it's capitalizing that same level. Look how much time it's spending, okay? It's spending at the mean threshold of a previous monthly order block. Hitting it, hitting it, hitting it, hitting it, hitting it, hitting it. Rallies away. Breaks these 2 equal highs. And again, I want you to take notice, every time there's a down candle, are they finding new buying? This down candle, they buy. This down candle, they buy. They buy more of it here. They fail to get above the high here. So when this low is violated, you have to wait for what? It has to trade back down into a higher time frame PDA. You can't find support at this bullish order block anymore? Okay, so what do? You drop back to a weekly. If you can't find it on a weekly, you drop back down to what? The monthly. There's your monthly level. Previous monthly bullish order block. Price trades into it. Rallies away. What's it aim for? The PDA above here. Old highs. Liquidity pool. Price rallies up through it. Is there new buying? Every down candle, we're looking for evidence that supports higher prices. Here, 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 here. How many pips have moved based on what we're already showing you here? Multitudes of pips. You're not getting a trade every single week. You're not getting a trade every day. You're getting sizable moves, swing trades, based on the idea that the price is going to be eventually driving towards what? Remember, the goal is it's going to reach for the premium levels up here. But it won't do it in one shot. It's going to gradually move up here because it's a lot of pips. It's 1,260 pips. It's not going to move in one day that much. So if it's going to have 1,260 pips, or this is rounded to 1,200 pips, if it's going to move 1,200 pips, the banks are going to want to capitalize on that move and be able to build them positions by taking out those individuals that are already long here, knock them out, and then build in more buying, more buying, more buying, come back down, recapitalize. Why did this level have such a strong reaction? Because look at the consolidation in here. We moved away from it, came back down to equilibrium again. The range of this low to this high went right down into equilibrium right there. That explosive price movement was because they had finally built enough of their position in here to now cause a large displacement in price. Once it takes off there, it doesn't give anybody opportunity to get back in. They're going to be waiting for a cheaper price. That won't come. Support resistance guys are going to see this as support. They're going to want to buy down here. Price will never get down there to give them an opportunity to get in. Equal lows, what's below that? Sell stops. Boom, they run down the sell stops. Why? Because that's the last run before we get to the level that we've already identified on the monthly premium level. Bearish order block defined in here. Price trades up to, look at the bodies on these candles up here at 74.46. Look at that. Yes, we wick through it. Okay, we wick through it, but look at the bodies here. Okay, I did not go through and create some kind of perfect scenario where it lines up where I can talk about like things like this. It just gives further evidence that this is what the price reaches for. So if you apply order block theory and all the PDA arrays that we talk about in reference to where market price is now and what's above you in the order you look for them and what's below you in the order way you look for the PDAs below you, it's a step-by-step gradual definition of what price may reach for. Again, there may not be breakers. There may not be a mitigation block, but there is a void. There is a fair value gap or a bearish order block. There's one of those things that you're going to be aiming for. And every time you look from a higher time frame, you have those levels on your chart, the market will want to reach for them. And you have to submit to that on these lower time frames. Now imagine having these ideas here as a day trader. It probably wouldn't be as significant to you, okay, in terms of intraday price action. This wouldn't be so sensitive to you because you're not thinking about the monthly chart as a day trader. You're not thinking about a weekly chart as a day trader, but you should be. As a short-term trader, you should be definitely thinking about these types of things. This down candle here, bullish order block, gets capitalized again here. It rallies back up to what level? The monthly bearish order block. Let me scooch this over a little bit. Order block low. Trades right to it here. That's real resistance. It's not a zone. It's a specific price level. This is a specific price level. This is a specific price level. It's not ambiguous. It's not moving around. It's not changing. It's not morphing into something all the time. It's not widening as a range or reducing as a range. It's a specific price level, period. So we don't know if it's going to go to the open or if it's going to go to the mean threshold. We look at this as an objective, 73.87. So 73.80 or 73.85 That's a viable upside objective. So if it hit that level here, you could move to the sidelines and say, okay, I'm done. If it comes back down and gives me a buying opportunity, I'll try to take it again, which it would be here. Okay, the levels are a monthly order block high and bullish order block opening. I think that one's this, if I'm not mistaken. It might be this one here. And price rallies here. Several, what is that? Let me get this thing out of the way. Almost 400 pips here. That's a big, big move, big move. And it fails right at a level that you would expect to offer resistance because you don't know if it's going to violate and go through. So if you took off, say you took off half the position here or even a quarter of the position off, and you start to erode. Okay, did you fail as a trader? No. You executed, you profited, and you may see some of the give back, and that's going to happen. But it gives you information now. Okay, well, we failed now 2 times. We went up into the bearish order block opening, the low, we're showing rejection, sell stops below here, and now we're back in this candle here where there was buying. Price should bounce again. Okay, we can take a buy it. Rally up, rally up, rally up, rally up into the high to the low. We're at a premium, which is the low end of the premium, but nonetheless, price offers an opportunity to be paid again, but then gives up the ghost and goes lower. Now look what's happening. This low has been violated here, and now we broke this one here. So is price indicating that it wants to go higher or lower? It wants to go lower. We're looking for bearish order blocks. Price goes up into this candle right here, but does it show willingness to sell off? No. So you can't see any more selling opportunities here. It now validates that it has resumed its up move. Every down candle, if this does not offer bearishness, which it doesn't here, okay, it trades right on through it, you can't view the market to want to go lower. You have to change gears. How do you do that? Find the down candle, and is there buying in the down candle? Here's your down candle. It trades into it. Boom, it rallies. Here's a new down candle right here. Price becomes a valid bullish order block. This one here is a bullish order block when this candle trades higher. This candle's high. Boom, there's your opportunity to buy again. And you capture that little bit of a, it's not much, but it's over 100 pips. Again, took several days to do it. Did not get above the old high, but what levels did we look for? What PDA level did it go for? It's a breaker. I'm sorry, good grief, I said it wrong. Rejection block, right above these candles, bodies. Let me just bar this level just for a second. I'll make sure I delete it. Went right above it, hit it, and then rejected it. So you have to have all these levels in mind. And what I do is actually have, and you'll actually see this one in your PDF notes. I actually give you my my map that I have, basically, that I draw out special notations about levels I'm looking for, and it keeps me in mind of what all of the PDAs on the monthly, the weekly, and the daily levels for the pairs that I trade or the market that I'm trading. I have that, and also just keep a reference point like every hour or so throughout the day. I'll just put a little like a mark where I'm at now, and I think about, okay, right now this is where price would be at market price, and then what PDAs do I have above me, and what PDAs do I have below me, and I have them mapped out from a monthly, weekly, and daily basis. So that way when I'm looking at intraday charts, I don't lose sight, even though my intraday charts don't have every single one of these levels, I have them in my notes. So for instance, if I'm looking at 72.90 right now, my notes would say 73.85 and bearish order block, the low level, that's what I'm looking for. On a monthly level, I'm looking at 70.80, which is the level just above 70.75 that we have noted here. Why am I looking at 70.80? Because it's higher than the lowest low. This would be the optimal entry, or exit point rather, for a downside movement or a target. But I want to get to the institutional level that's just before that or higher, which would be 70.80. So I would have that level in my notes, okay, which is just basically like a rough template. It gives you an idea of what levels to be looking for at a real quick looking at it, and you don't need to go through all your charts. And that's why sometimes when you hear me talk, I have levels off the top of my head because I see them. I see them in my notes right next to me. I have, well, I can't show you because I don't have a webcam hooked up to it, but I have a notepad, and I also have like a little template. I have all my pairs or marks I'm looking at. I have it outlined, and you'll see it. You'll get it. You can print it out and you can actually start doing the same thing I do. But just know that when you go through the price action like this, you're going to have a whole lot of lines initially, but you don't carry them all throughout all your time frames. All right, we'll move down into a 4-hour chart. And again, this is the only time frame that we go down into for this month. We can't go any lower than this for teaching purposes. So here's the first buying opportunity, and the one we looked at that's second in the order of left to right from the homework I gave you. We're going to look at those on the 4-hour basis. The bodies of the candles. Okay, that's your order block. Okay, does it move 1, 2 times? Yes, it does. Price comes back down, trades down. Does it hit the order block down here? No, it does not. We have 1, 2 candles in here that make up the order block. I like to use the biggest portion of the body of the candle as the order block. I don't use the wicks high. I don't use the wick low. I use the body. And the reason why is because all of us are going to have slightly different candles, okay? And you're going to have different price points that would cause your candle to be slightly different than the one you're seeing here. Let me zoom in. Yeah, it should be a lot easier to see now. I apologize. Sorry, I take it for granted because my screens are really big. So when I see it, it looks huge, but now it's enormous for me. But now you're looking at the body of the candle here. When you look at the order blocks, you want to take that range and highlight it. Okay, and visually what you're doing, you do not have to be so demanding that you actually do all this all the time. Like there's 1 of it and there's 2 of it. So if price moves that far away out of the order block, it's a valid order block if it comes back down. And that's how I qualify strong buys with the order block theory. Right there. Okay. So now, when we look at price action in these areas in here, you'll be able to go to a lower time frame and reduce this down also. But when we look at opportunities to be a buyer, we're not looking at just order blocks. We're not looking at just bullish breakers or mitigation blocks. We're also thinking about what? If the price is ultimately wanting to go higher, market makers already know that there are going to be participants that are probably going to be on the right side of the marketplace. So what trading pattern or what institutional price swing do I say I like doing more than any other? Let me check your responses, make sure you guys are paying attention. Breaker swing. Breaker swing. So that means we're looking for the market to trade below an old low. Why? Because we want to see them scoop up some sell stops. Because if they knock the market participants out that are already long, they know there's willing sellers down there so they can buy from. And that's what you're seeing here. Short-term low, price trades down through that. That's the ideal entry. You're going to see that that type of pattern happens more powerfully in terms of seeing price go the direction you think it's going to go. If you see these types of events, that's where the best entry points are. It's the scariest when you get in. It's the scariest ones to take because it feels like once you start, well, think about if you were in this market and you watched it drive down like this, it's very scary to want to buy below that old low because you don't know if it's going to keep going lower. Classic chart pattern traders are going to see this as a bear flag and it might go down that much lower. Not necessarily. You've got to think where the sell stops are and why would they want to go down there? To take those individuals out and assume their position. Short-term low here, you see it here. Every time there's a move below an old low, look at the responsiveness. Below an old low, responsiveness. Short-term low, below it, responsiveness. That coupled with down candles supporting price, there's your 2 strongest points of looking for institutional order flow, telling you what the smart money's doing. There's 2 of them. Very simple. Is the market going below an old low, and is it rejecting immediately and showing strong buying? If it is, smart money's buying that market. If the market is showing support at down candles and it repels price higher off those, Smart money is buying that market. You don't need indicators. You don't need trend lines. You don't need moving averages. The price action will tell you everything you need, and it only takes you seconds to look at it. You start on a monthly chart. You move down to a weekly chart, down to a daily chart, and you look at it on the 4-hour chart. All your timing comes by way of those two things too. You're returning back with a failure swing, which is a bullish order block is what that is, or a bearish order block. That failure swing, institutional price swing, that failure swing, that's the weaker of the two. The best one is when it runs down below a low to take out sell stops. That's your entry for turtle soup. Two entries, two forms of looking at the marketplace, two ways of gauging institutional order flow, smart money accumulation and distribution, and it's simple. And when it's bearish, is the market going above an old high and rejecting quickly and going lower? Or is it trading at up candles and then rejecting price lower? That's a bearish order block. It's showing every time it rallies, it can't get through that last up candle it traded to, and it's being repelled. It's being distributed. That's it. There's nothing else to it. So when you apply these things from a monthly, weekly, and daily and 4-hour, and overlaying your levels that you've seen from the higher time frames, you'll see that these markets move off these levels with a great deal of precision and expectancy. You can see it come long way down the road before it ever gets to them. The responsiveness. I mean, look how many times price reacts at these levels. And all I have on here is the monthly. I've not added any of the weekly or the daily or any of the individual 4-hour charts levels. But there's a lot of responsiveness at these levels, and they're not ambiguous. They're specific. The reference points of the monthly high of the bullish order block, the opening of the order block, or the thicker one is a mean threshold. And there's only two of those being noted here. But look how price moves and gravitates from each one of these levels to another level that means the equivalent from a monthly basis. They're not ambiguous levels. They're not just indiscriminately thrown on the chart. They're not form-fitted to make perfect examples. They are levels that you can do on your own, going in your chart and seeing it for yourself. And that's the basis of looking for swing trades, because if you can see where the highest probability of motion away from or repelling from that level, whether it be support or resistance, it'll give you all of the scenarios that you would need to be a profitable, successful swing trader. I mean, it's phenomenal if you start going through it like this. And again, these are just monthly levels, and we're not done anything with anything less than that. So how many opportunities are you seeing off of a monthly level and reactions thereof? Do you have to wait a long time sometimes for them to come? Yeah, absolutely. But some of you can't trade every day anyway. So this might be your bread and butter swing trading model, only looking at monthly levels. Guess what? You're going to get the biggest bang for your buck when you trade off of a monthly level, because that's where the funds are piling in. They're dogpiling in. There's huge amounts of flows coming in at these levels because it's a long-term level. Real support and resistance ideas applied to these higher time frame charts, because they need these types of time frames to be able to position themselves in on these big moves, because the big moves don't turn on a dime just like that. They gradually move. Once they happen, price takes off, and you get a very sizable displacement. You know, from moving from 70 and a half, let me get this thing out of the way, up to 72.50, you know, that's 200 points right here, this move here. And it didn't have to go up to the premium. It just went back up and closed in the void on the 4-hour chart. You see that? So I'm going to give you further homework now that you want to take the levels from the daily and 4-hour and apply them to the same Kiwi market. And we're going to look at that tomorrow in our session. We'll actually start looking at some of the setups and how we frame the ideas going forward. But you have to start somewhere in terms of what makes the move probable. What gives your idea of a swing trade coming to fruition the basis? Because it's simply just not enough because you want to be a buyer, okay, and there's candles and trend lines and moving averages and indicators telling you it's overbought, oversold, or divergence of some kind. That's not enough. There has to be an invitation, if you will, on a higher time frame chart to draw in large funds. That's going to come by way of looking at monthly and weekly time frames. And if you look at those levels and take those levels and transpose them. Now notice that we didn't just take old highs and old lows. We looked at just order blocks. We framed it out on just the order block theory alone and used the range defined by the monthly chart. That's all we did. If that's your trading model that you go forward with and that's what you trade with, look how many opportunities it gives you. It's beautiful how many trading opportunities it gives you. It's not overkill, but there are opportunities that give you a huge amount of range to trade in, and it doesn't have to be executed on a 5-minute chart or 15-minute time frame. You don't even need a 4-hour chart, really, to be honest with you. You could trade off of the daily chart because it gives you a moment of, not a moment, it gives you more than a moment to make a decision, okay? It gives you time to plan the trade. You know when they're coming, where they're going to be forming at, what levels to reach for. And when price gets down there, you know what you should be expecting to see. Responsiveness, should there be buying? Okay, is there displacement? Does the order block exist, or is there a short-term low? If it trades down below that short-term low and you're at a level like it is here, okay, when price trades down below that short-term low, that's an opportunity to be a buyer. Normal retail mindset will say, no way, I'm not buying that. And you have to be diametrically opposed to that mindset. Because if you can't think like that, you're going to have problems. Look what we have here, the low here. Right here, this low, and we have this, let me get the show up. Monthly order block open. It stops short just above it, rallies, okay, and look at the responsiveness of all these levels in here, and then drives down one more time below it. But it goes below this low where there are short-term sell stops for those that want to be a buyer. They take out the sell stops, but after it hits 69.82 level or 69.80 level that we would have identified. Was there a nice responsive movement away from price there? Absolutely. Buying below a short-term low, using a breaker swing, price rallies up. What's it doing? It's closing in the fair value gap in here. Price is only delivered on the downside. It's a little bit balanced in here because it's back and forth and consolidation. But from this low here, not the long candle, but the low right there to this opening, I'm sorry, this high here, there's an opening in price where only it's been offered on the downside. Price rallies up, closes in that right there. Once it closes it in, does it want to go higher? It's balanced. So now it's going to go back down to value. That's down in here in the consolidation. And it's allowed to go higher again. Is it allowing price to move away from down candles? Here's a down candle. It rallies away. Here's a down candle. Trades back down to it. It rallies away. Is it showing willingness to go higher? Yes. Is it being bought by smart money? Yes. What's it doing? It's reaching for a higher level PDA. Between this low and this high, what's in here? Price delivered on the downside only. That's a fair value gap. Price has only been delivered on the downside, so you're expecting to see what? Price delivered on the buy side. Boom, it balances price out. Does it stay there long? Hell no. Trades lower. But it's reaching up in there to fill that in on a 4-hour basis. What is it doing essentially? It's reaching up to fill that in, but also it's built in the idea with this nice move here. There's buy stops here. Folks are trying to short it. So they're going to come back up one more time after they fill the gap, and it moves up into a premium, range high to low. We're at a premium, filled in a fair value gap, took out sell stops. Price is not willing to stay here long. It reprices aggressively. Below the old low, where sell stops will be reaching down into a mean threshold. Look at the responsiveness again. Body of the candle. If you can't buy the low, don't worry about it. Body of the candle. 1, 2, it's a valid order block. Buy it. Reach back up into the areas at which the monthly chart has given you. Look at the responsiveness of this. It's reaching for where the areas are, all just based on a monthly chart. And here's where we are right now in current market action. There's one more thing I wanted to show you before I close. I want to go out to I think I've seen it on daily. I think it might have been in the weekly. Let me get a second here. I knew I should have wrote it down before I started, and I saw it, and I was like, well, let me make sure I make a mention of this. But I yeah, I think it's this one here. The low on this candle on a weekly low was 70.76, and the high, or the open, sorry, on the bullish monthly order block was at 70.75. I think that's what. Let's go out to a monthly real quick. Yeah, here's that order block here. Open is 70.75. Yeah, one pip away from that on a weekly range. Now think about that. I said this is a weekly range, and you're that precise with it. Now I would love nothing more to be able to say, look at this thing and hit the actual pip, 70.75. But are you going to argue with that type of precision, 70.76 versus 70.75, expecting some level of support or resistance, going lower rather? Supporting the idea that there should be some buying here and price should be responsive to that level. And look at the responsiveness after that. I mean, we opened here, price traded down, hit that level, and then traded higher. I mean, just alone in this weekly range, the low was at 70.76 and the high was at 72.25. There's your 200 pips. Now think, I want you to go forward with this because I know a lot of you are chomping at the bit that you want to get to the short-term trading and learn my one-shot, one-kill scenario because that's what defined me as ICT. Think what you're learning here and apply that in some of your daydreaming today while you're at the office or you're driving home from work today, or maybe some of you are driving to work. Okay, think about what that does for your short-term trades, how this will outline where the market will be reaching for, what levels it should key off of. It's not ambiguous. It's not, just thrown up there for the sake of making something match up. These levels are specific. And by having them apply from a monthly, and we only used a monthly, we didn't do anything with weekly, I'm leaving it up to you to come up with a way for you to organize your charts. Preferably, I would personally think that if you had a monthly chart separate apart from the weekly and have a daily chart separate as well, that way you can always look at where current market action is in reference to those levels. But if you're kind of like me, I have to teach you with usually one or two charts because I can't show you my platform because I'm not going to be hooking up my internet access to that. So you guys can have access to to seeing all those types of things if you want to be unsavory. The point is you're going to be able to have to come up with a way for your own organization. You can use one chart, and you can use the monthly, the weekly, and daily levels and 4-hour levels all on one chart. But your chart's going to be very busy. And the way you reduce that is just use line segments. And that would be done like this. Just use this little thing over here. And say this is a level you wanted to use. You draw it on here, and you draw it out in time. Okay, and then there you go. The problem with that is you're going to have to do a lot of extending sometimes to keep those levels updated. That may be too much for you to be bothered with. I'm sure some of you that create indicators could create something that keeps extending that, as time goes on. I'm not aware of how that could be done personally, but that's how I do my charts. I mean, I only follow a few pairs. So to me, to be extending that, it doesn't make a big deal. I always extend farther than I really need anyway, so it buys in some time. And on a weekend, Saturday, I usually just extend it out and set my charts that way. But I want you to think, by using this example here with the Kiwi, we've outlined the fact that this market had a bullish profile. It was not in consolidation. It was showing evidence that it was being bought. We were already talking about Aussie and Kiwi being bullish because of the interest rate differential between them and all the other countries. So there's a built-in tendency for these currencies to want to be bought. There's an interest rate differential that would be favorable for traders that want to buy these. Then couple that with applying the PDA levels that we just outlined here. Excuse me. And look how much action you get off of them. And they're not zones. They're not levels that move all around and gyrate and morph into something different all the time. They're static levels. They're static price levels. And the general rule of thumb is if you're above one of these levels, you round that level up to the nearest 5 or nearest 0 level. If you're below the market level, okay, one of these lines that you have in your chart, you round down to the nearest 5 level or the nearest 0 level. Me, preferably, I like to look at the institutional levels, the 80s, the 20s, and the 50s, and the big figure levels. I am not trying to fancy dance and get the last piece of the pie. I leave that for someone else. And sometimes, if I'm down here trying to get out at a move that would get me out here, and I miss this big wick, congratulations for those that stayed in. But guess what? If you were waiting for this, you never got it. So I want to make sure I have the highest probable exits if I'm using these levels as targets. And same thing is said, if I want to be keying off those levels as entries, I'm 5 pips ahead of the level, regardless if it's at an 80 level, and I think that the level is 85, I'm getting in at 75. I want to make sure I get in the trade and I build in enough cushion for the stop. And that's what we'll talk about later in this month about entries and actually how to manage the stops and all that business. But again, I'm giving you a framework today in relationship to the homework assignment I gave you for the Kiwi. You may not have these levels on your chart. You may not even seen this in your price action, and that's okay. You know how to do it now, and you know how to do it going forward, all the pairs and the markets you trade. But this is the reason why I teach, and everyone that's very efficient with trading, if they're very technical and they have a specific concept in mind that they trade with, they don't trade a lot of pairs or asset classes. They have one thing that they specialize in, and that's what you should do as well. So I'm going to close it here. I encourage you to do your study on the daily and the 4-hour. You can do the weekly, but just for now, just for the sake of tomorrow's discussion, let's look at the daily and the 4-hour levels on the Kiwi, and we'll refine all this in another teaching for a live session for Wednesday. And until I talk to you then, wish you good luck and good trading.